Yes, welcome again to our income tax class. After a long gap, I am meeting you in the video session. Today we are going to discuss about capital gains, income tax, the chapter capital gain, problem taken from Gaur and Narang. See, in this we are given with the assessee purchased the house in the year November 2000 and the year November 1997, and the asset was transferred to the present owner, Mr. Krishna. Mr. Krishna received the gift in the year November 2007. So you please underline that point. Though it was purchased in the year 1997, it was actually purchased by his previous owner, by the previous owner, whereas now Mr. Krishna became the owner in the year 2007. So what we have to take, two things you should keep in mind. Actually, the asset was purchased prior to 2000. So if it is prior 2000, then we have to take indexed for that one actual cost or fair market value we have to take. And another one is the present owner becomes the acquired the property, becomes the owner of the property only in the year 2007. So we have to apply the index point for 2007. Okay, so always you should keep in mind this point. When the asset was purchased after 2007, straightway we have to take that present cost. Whereas if the asset was acquired before 2007, then we should see that fair market value or the cost. Whereas in this case, another one point is also given in the question, that is the present owner acquired the property only in the year 2007. So we are taking it the index point for 2007, that comes to 129. So what is the value consideration? 35 lakhs 60,000. Expenses on sale, it is 60,000. So net consideration that comes to 35 lakhs minus indexed cost of acquisition we have to take. That indexed cost of acquisition in the sense the cost into index point for the present period divided by index point for the year of acquisition. For the present period that comes to 331, and this 331 is the constant one for your batch up to the March. The entire things, your present cost of index point is 331 only. It should be in numerator divided by that amount is 129, denominator is 129. This is for the year of purchase, that is 2007. So if you apply this value into present cost of index point divided by index point for the year of purchase, that comes to 25 lakh 65,000. Then in case of a long term property, then long term asset, you have to take index point for the cost as well as the cost of improvement. What is cost of improvement? That is, I acquired the property, then some value additions are made on that property, then that is called a cost of improvement. Mind it carefully. In a cost of improvement should be considered only if it is happened, if it is made after 2000. Prior to that, cost of improvement should be immaterial, we should not be considered. Point 1. And point 2, that index point that should be applied only if it is a long term property. In this case, it is evident that it is a long term property. So cost incurred for the improvement is 2 lakhs into 331 is the, as I already told you, 331 is the present cost of index point divided by 167. Why 167 we are taking? You please have a look on that point. See, in the year of improvement made 1011, that cost of index is 167. Okay, so 2 lakhs into 331 divided by 167 is, that comes to 3 lakh 96,407. What is the balance final result? That is called a long term capital gain. So always keep in mind, this is a very simple problem. two things you should keep in mind. One, when the asset was purchased. If it was purchased prior to 2000, then you have to take cost or fair market value. Then, in case of a long term asset, improvements are made after 2000, then you have to consider that improvement based on the cost of indexation should be applied for that. So final result is 5,37,701. Then this is the basic point for your essay type question also. Then what else you will have after this long term capital gain? How that long term capital gain is invested, because you are all well aware that long term capital gain, it is taxable. Then if the amount is invested in some notified avenues, then you can avoid the tax. Okay, for example, to say this is what is the nature of asset? This is a house. The nature of asset is house. If the same asset is invested, the amount is invested for the purchase of another house, purchase of another house within the notified period, then you can avoid the tax. To that extent, you can avoid the tax. So all those things will be discussed in the forthcoming classes. Now you should know how to calculate the index point, how to calculate the indexation of the cost, indexation of the improvement, cost of improvement, what is long term capital gain. Also, you please keep in mind, index is only for long term asset, not for the short term asset.